Robschild, no investment advice. Welcome to the show where we view the financial markets using Benjamin Graham's investment philosophy, macro technicals, and a touch of crystal ball gazing. Today is Wednesday, June 4th, 2025. Today's episode begins with our headline, Hard Data Piles Up. ADP employment hits 4-year low, just like PCE very recently. Although the US ADP non-farm role employment change was positive, it was far below expectations, only 37,000, much below the 111 forecast. I saw 110,000 forecast as well. And not only that, this is the lowest that this number has been in 4 years. Last time we saw this low was in June of 2021, exactly 4 years ago. So although not negative yet, the key word here is yet. As you can see, before the great financial crisis, we had lower and lower ADP numbers until they got a few negatives and then a few more negatives, and then all of a sudden, all heck broke loose in the great financial crisis. This 4-year low is not a good sign for the economy and acts as a bit of a bellwether for Friday's big employment report. We also had a report coming out today. The ISM services contracted in May. In other words, below 50%, granted not by much, or at 49.9%, but the expected was expansion here. While the last was a little bit lower, we were expected it to increase even more in the ISM services, and instead we actually had a small contraction. Whenever the ISM services PMI is below 50, that means it is contracting. It is getting smaller. And although we have seen it dip below 50 a few times in the recent history, June of 2024 was the last time we had a negative rating or a below 50 reading. Before that, we had an April reading. And before that, we didn't have one since December of 2022. And before that, we didn't have an ISM services PMI below 50 since COVID. The question I'm asking myself right now is this just another little dip below the 50% mark, or is this one of these times where we start going lower and lower, contracting further and further? This data, along with the beige book coming out, the Fed publishes a beige book which gives some insight. You may have seen some headlines discussing sales not being as strong as people were thinking. All of this affected markets. We'll get there when we get there in the charts. First, community topics. What moves, if any, did you make today? Robschild sits on hands, doesn't do anything. And for those of you concerned about the audio quality, yes, it's because I don't actually have an XLR cable. I have a very nice audio system. I use a Focusrite. I use a SM. What is this thing? This is a very good mic. It's a SM57. But the cable I'm using is not designed for mics. It's designed for MIDI communication. Not only that, I had it coiled up right next to some other wires. So it should be better. Anyway, comment. Any thoughts in the comment section below, especially in regards to any movement that you have may have made today. Coming up, besides tomorrow, we do have initial claims and continuing claims. This is a weekly report. All of a sudden, we'll get a shoot up in that, and all heck will break out. You can count on that, but we'll see tomorrow. But the real big report of the month that markets are really acting like they're waiting for is the unemployment report coming out on Friday. We also will be continuing to see tariff updates and federal budget updates. Thank you for watching, subscribing, commenting, and supporting. The subscription button's right over here if you like the content and want to follow me for more. Daily reminders, macro views the same. Click the link in my description to read an explanation. No changes in the crystal ball ratings nor the Robschild portfolio. On to the charts, starting with the SPX. The S&P 500 was allowed to eke out a 0.01% gain on the day, mostly because yields dropped because The employment data came out weaker, the ISM came out weaker, the Beige Book came out weaker. So yields were actually very much allowed to drop. They dropped a good amount. TLT went up a pretty good amount, but it didn't light the spark of the bulls in the stock market. We even saw some rotation back out of the utilities sector, something I've been talking about recently, getting to back to its all-time high, dropping by 1.75% today. This being safe money, defensive money, we're allowed to go into TLT now with all this data coming out today. So TLT got a pretty good bid. We closed 1.6% up on the day. I also want to point out a pretty clear inverse head and shoulders. This adds more bullishness to TLT the way that I see it. Short term, the target of this little inverse head and shoulders on TLT is going to be around 89.70. If the trend of weaker news continues, as I sort of expect it to continue tomorrow and Friday, it should easily get TLT up to that target, in my opinion. So yields are dropping and money is not getting super excited about lower rates raising stocks. I keep hearing traders talk about lower rates means higher stocks. It doesn't always work that way. They're not always correlated that way. Sometimes they're inversely correlated, where people are trying to run out of risk assets and go into the safer assets. And a day like today is exactly it. The market did exactly what you would expect here. Part of the subdued movement in stocks is presented here in the IWM, the Russell 2000, still unable to get over this line that I've been talking about in many shows. Also, crude oil just going flat here. Another leading indicator that I am addicted to at this point is following the price of Fartcoin, of course, down 13% today. Meme coins in general are not a terrible bellwether in terms of appetite for risk assets. Remember, there are people with a total of $950 million worth of perceived wealth. It's not wealth until you sell it. $4, by the way. It's sort of the most extreme risk category that you can track on a minute-to-minute basis. It's a sort of a part of Mr. Market's pulse. It's almost like how much sugar does he have in his system right now, is almost the way I would kind of illustrate that. Junk bonds don't see the fear here yet. When you have weaker data, a lot of the time it's like, credit spreads need to widen a little bit. We're not seeing that, not yet. Although this was yesterday's movement, and if you want to get today's movement, you either need to have access to better tools than me, or just take a look at HYG divided by Shy, going completely flat here. So the market hasn't lost its appetite for higher risk credit yet. I think that could change even as early as tomorrow, but definitely Friday, again, if the data comes out showing further weakness in jobs. The continuing theme of today is more neutral than anything. The put to call ratio, the blue line being puts, basically 2 calls. This has been rising, so less people are getting less betting on the market going to the upside, and a little bit more, betting that the markets may roll over to the downside. More neutral than anything, and this is further confirmed in the CNN Fear and Greed Index, which finally dropped back to neutral. It's been in greed mode for, I'd say, over a week now, every day being in greed. We finally got to neutral, which is normal. This is what it should be doing. Mr. Market is patiently sitting on his hands waiting for Friday. really, more than anything, the unemployment report. But again, anything in the news, and especially initial claims and continuing claims, might shift things around as early as tomorrow. So that's all from me and my crystal ball. I hope you enjoyed. Thank you for watching, and see you next time. Robschild.